Wall Street Week host David Westin. He spoke with Paul Krugman, Nobel laureate in economics, and David got his take on the state of the U.S. economy.
We are in an extraordinarily good, immediate position. I've been arguing with people who say, this is a Goldilocks economy, and that's wrong. Goldilocks found a, porridge that was neither too hot nor too cold. We've got an economy that's hot where you want it to be hot, like in GDP growth, and cold where you want it to be cold on inflation. So this is, right now this is in a lot of ways the best, short-run economy we've had since the 1990s. So what we need for the next 4 years is to be thinking about the long run.
Do we need to at least start to think about the deficit and the debt that's accumulating? Because right now, as you look at Donald Trump and Joe Biden, the two leading candidates, neither one seems to be willing to address that. By the way, this week, Congress did do something on taxation, which was actually it was negative in terms of the deficit. So do we need to address that question? And if so, when?
I'm not a complete deficits never matter guy, but I'm not. It still doesn't look like a first-rank issue, despite the the enormous numbers. But everything about America is enormous, and particularly there's a lot of the sustainability of debt depends a lot on comparison between interest rates and the economy's growth rate. And right now, what we have is interest rates seem to be coming down. Growth seems to, productivity growth is looking really good. There are high hopes for AI, all of which means that despite the huge size of those raw debt numbers, I actually don't think that there's any urgency. Someday, but if you want to ask, given the range of things that can politically be done, we actually just did something quite good. I mean, I don't care about the business tax cuts part of it, but we're actually helping poor families with kids, and those sorts of things are a lot more important than the deficit right now.
History, we're told, does not repeat itself, but it does rhyme sometimes. Is there a rhyme with 1993? Because if you go back to 1993, you talk to Bob Rubin about what happened with President Clinton. It's thought that we got a lot of growth out of the 90s in part because we both increased some taxes and cut some spending. Is there a similar opportunity here for pro-growth policies?
I'm a great admirer of Bob Rubin, but I don't believe that story for a minute. It's just not what looks like actually happened in the 90s. What actually happened in the 90s was that businesses finally figured out what to do with these computer things, and we got a decade of good productivity growth because we finally figured out how to make productive use of IT. And I actually don't think that Clinton administration policies made much difference one way or the other. So I just don't buy that. It's just, and we may be approaching another moment like that. Again, recent productivity numbers are really quite good. AI, maybe it's either going to destroy us or possibly give us another decade of good productivity growth. So no, I just don't. That whole responsible fiscal policy was responsible for the roaring 90s. It's a lovely narrative. I don't think there's anything to support it.
So let's turn to the economic approaches, overall approaches of, again, let's talk about Joe Biden and Donald Trump, the two leading candidates right now. How different are their approaches? We had Glenn Hubbard, actually, and he said his concern was they were too much alike because of populist notions such as protectionism.
Okay. I think a lot about protectionism. It's, that's what my life is built on, is that kind of stuff. And in general, it's overrated as an issue. Now, you can do damage, and some of what Trump is talking about now could actually do significant damage. Put it this way, very much, Biden is what in Europe you'd call a social democrat. It's definitely about a stronger social safety net, higher taxes on top incomes. He actually did quite a lot more than people realize already in that direction, despite having a minimal majority in Congress for 2 years and nothing at all since. We've had substantial enhancement of Obamacare. We've had a lot of investment in children and families, and of course infrastructure. Finally, after infrastructure being 2 weeks away for 4 years, all of a sudden now we actually have it. And Trump is not. Trump, for the most part, except for his protectionism, Trump is very much a standard, tax cutting, let's not spend money on people Republican. So no, they're very, very different in terms of likely impact on families in America.
And what about effect on the economy? And you mentioned the tariff issue before.
Yeah.
President Trump, former President Trump, has said that he would favor a 10% across the board, not just China, across the board tariff. Right. And actually, Mr. Lighthizer, his advisory secretary, maybe we increase that to eliminate trade deficit. What would that do to the growth of the American economy?
Okay, now a dirty little secret of international trade economics is that moderate tariff rates do not, at least according to our models, and as far as we can tell in practice, don't have huge growth effects. They distort consumption and production choices. They do some damage, but to get really big numbers, you have to get well beyond 10%. So of course, if the goal is to eliminate the trade deficit, Lighthizer was going to have a surprise because tariffs don't eliminate trade deficits unless they get so high as to basically make trade impossible. So we would be talking about much, much higher tariff rates potentially. What's worries me is not, I think there are a lot of really negative consequences if the U.S. does a 10% tariff, but they're sort of geopolitical more than anything else. They would mean that the United States is basically saying, well, we're opting out of our role as a leader of the global economy. It would have a lot of bad effects. In terms of the economic impact, I'm hearing talk about, well, let's have 60% tariffs on imports from China. And, tariff, roughly speaking, the adverse effects of a tariff are proportional to something like the square of the tariff rate. So a 60% tariff is, 36% times as bad as a 10% tariff. So if we start to get into those kinds of tariffs, then we are actually talking about significant negative impacts.